Hello and welcome to I Want to Grow, and I Want to Grow is all about that, right? It's about our growth. But with our guests, it's a little different. These guests, they help others grow, and they're the best ones for our podcast. So Bilal, thank you so much for coming to join us today, and thanks for coming on to our podcast.
The pleasure on all mine, and pleasure to be here. So my name is Bilal, and I'm a VC and operator. I come from both backgrounds of being operating startups and deploying capital within the MENA region and beyond.
You started some events back in the UK. What was that all about? Tell us about that.
Are you talking about the first startup that I did? So back in the day, we're talking about 5-6 years ago, we started a company called 𝗕𝗿𝗲𝘃 Technologies. It's a logistics tech company that aimed to Uberize the shipment industry. It failed spectacularly after a couple of years and raising a couple of $1 million. The upside out of that is that the technology got acquired by a last mile delivery company that were aiming to maneuver their riders and their technology behind it. And from there on, that was my first reality check towards startups.
Yeah, reality check, because you've done really well, and I love your progress. I've been watching it for quite some time. Okay. What is it like to lose somebody else's money?
Oh, well, technically, I did not lose all of it. So I returned a 0.9x to the investors at the time. It's not what they hoped for of the 3 or 4x they were looking into. But it's an interesting reality check of how startups operate. Founder market fit, product market fit, the execution playbook that we looked in. We've done a lot of expensive mistakes. I was happy that I've done that early on. In my career rather than later on.
I suppose it's the harsh reality that sometimes these things happen, and I want to keep on this point because it must be, what is it like when you're first raising and you're going to be using somebody else's money? Is that a lot of pressure?
It's definitely a lot of pressure to have someone else's money in your company, but one way or another, it's the nature of the game, right? You need money to grow your business. You need money to execute on the products. The nature of the asset class that they're looking into, they know how risky it is. It's been like that for the past 50 to 70 years, so it's not something new to them. But it definitely puts a lot of guardrails on where you're heading and how you're moving toward managing that company. And most of it's actually good kind of correlates. So they come with a lot of governance. They come with talent selection. They come with a lot of support that they can put. Of course, not every VC do that, but I was fortunate enough that the ones that they did were very supportive.
And I'm going on this because I want it to be helpful for all of those new startups that's out there.
Yeah.
Taking that tight, because that's not a small amount, $2 million.
Yeah,
not a small amount, but it's like, it must be so much pressure to kind of make sure, or not pressure, sorry. It must take a huge amount of confidence to look up and say, I'm going to take that to a 3, 4, 5x, because you've got to believe in that what you're doing.
Absolutely. Look, every founder and at some point has to believe unequivocally that their business is going to make it, and it's only a delusion until it happens, right? You need to have that conviction in the project that you're building, the products that you're trying to do. Whether you're right or you're wrong about that kind of conviction, only time will tell. I was wrong about mine, but many others were right at the time, and it is necessary to have that level of determination. I would say it's a red flag not to have that level of determination in place.
Is it difficult to pick yourself back up, dust yourself? You did quite well. They expected a bit more, but was it difficult to brush yourself back down and get back onto the next one?
Absolutely. It took me some time actually to jump into another operator role. So after that, they moved toward consulting, where I did a classic management consulting services as a TMT associate at the time. It worked with big tech names as Microsoft, Oculus, Facebook, Meta now, right? A few others in the industry. you get to see how big problems manifest themselves, and you get to see how big corporates do operate, how they look into problems. You get to see how big machines in tech do process things in how they approach markets, how they approach consumers, and you realize that it's a different kind of ball game when you look into things from the other side of the funnel, because if you look into well-established businesses, right, and they tend to have bigger problem to solve, more sophisticated clients, the different product lines, a lot of bottlenecks that they need to look into a daily basis. It gives me another perspective how the market operates. So it was definitely a needed experience for me personally after my first operating role, and then from there on I moved toward VC. I did my first operating role, and now I understand how tech companies operate well. Why not invest in them, right? And that's how my VC as a career started.
When was the first time that when was it you decided to come to Qatar?
Oh, actually, I lived most of my life in Qatar. So early on, I was living in Qatar. Then I moved to UK for about 10 years. And then I returned back to Qatar. So it's when I joined at the time the first VC program in Qatar at Qatar Development Bank, and this is where
I first met you.
This is where
I've still got you on my phone, but I've put VC Bilel candid.
It feels like ages ago. Actually.
Yeah. It does feel like ages ago. And then I remember talking to you at so many different events as well. You must have learned a great deal over those years. So when you lived in Qatar before and you went to the UK, was that a really good education process for you, but going back there?
Oh, absolutely. Look, I do love the UK and do love the ecosystem there. It's good as well to cross compare what we have here to what the ecosystem looks like in the UK, right? From an educational perspective, I was very pleasantly surprised of my education. But if we're looking to the innovation ecosystem, there was a lot to see. There was a lot to compare. So there's a lot of good facsimiles are happening. There's a lot of good growth trajectories that are happening, and you start to see where the ecosystem headings when you see things at the mature stage, right? It was definitely a playbook that we're looking at. Yeah.
I'm being a little bit biased. How important is it for startups to experience traveling, to get out of their comfort zone, to see how things operate around the world?
Well, absolutely. Look, if you're building a startup, it's a global venture. You cannot build a startup without having globalized business models. If you're aiming to build a unicorn or even a healthy startup growth, right? In Qatar alone, it is very unlikely to happen because the market is relatively small, right? So if you're going to build a startup, it is worth noting that you have to build, yes, with a sight of being local, but as well being international. That product has to have consumer base, not just locally, but internationally as well. And the only way to understand international consumer behavior and how the markets operate, how the market shifts, the move of risk capital, and how capital manifests itself as well. A lot of traveling needs to be happening, and a VC is an international game. It's not a local game. It's a business of proximity.
I've seen you grow even more. I've had these conversations with you over the years, and I see you to another completely different new level now. And I've seen you operate. We were lucky enough to spend some time in Armenia, and I listened to some of your talks, and you seem to have just come into a different zone now. When I saw you hustle, making sure things were working properly, having your head spinning with the startup, with all the things that you were juggling, and then trying to raise finances at the same time. So I've been really fortunate to see your growth, and really it really is you really do look totally different from running a startup to being that VC now. Was there times when you, with all that experience with those startups, and now you're as a VC, that you said, oh, I wish I would have just taken that into consideration years ago?
Well, there's a lot of lessons learned down the way, but there's a lot of things that I wish to have learned earlier. And I think that's a journey that every founder has to be taken into consideration. There's a lot of things that that we could have saved our time is. One prevails most is that we need to understand that how VCs operate on the other side of the spectrum when we are aiming to fundraise or when we're aiming to operate within the VC world. Look, VC is a product of private equity, and private equity was a product of leveraged buyouts. Yes, VC is a 50, 60 years old financial product, right? But it is one of the riskiest assets out there, and has a lot to do why it operates the way it does in this part of the world as well. And us understanding that gives us the ability to understand the different risk profiles, different appetite profiles, who should we fundraise from, who we shouldn't fundraise from, what kind of VCs should we approach, what kind of VCs should not approach. We should also understand how the ecosystem functions, what VCs has to offer beyond the venture dollars. So all of that was an interesting learning curve for sure.
And what's the? It seems like you've learned a great deal, right? Is it a scary place being a VC? Is it worth being a VC? Lots of risks.
It's a tough game. It's not an easy game. You know, if we look into a VC as an industry today, I was just reading a report this morning, and it says that 41% of the venture dollars in 2025 year to date has been deployed to 10 deals only. That's $83 billion in US venture dollars. The industry has never been this concentrated since the dot-com bubble that we actually see. Look, most of VCs plays the stat game, or what we call the spray and pray, but it's not necessarily how things that works. But the math really is not really on our side. If you look into the VC as an industry, you'll see that 7 to 10% only were able to return 1x of the money to their investors, and we're talking about what, 4,500 to 5,000 VCs worldwide. So we're talking about 450 to 500 VCs that were able to just return 1x after 7 to 10 years of managing that cap. That's horrible, because you know, if you're returning 1x to your investors after 7 to 10 years, you better shut down that fund, because they'll be better off putting that money elsewhere. They'll be putting it in S&P 500 or an index fund. They'll be returning a cumulative about 25 to 30% at that time, if it's not more. And then you have no edge moving forward from there.
I know that in the past you've even seen banks or development banks that have looked at it and said, let's just leave the fund that we've got and get, as you just said, leave it in the bank. We're getting a better return. Why take on these risks, these numbers, where we're probably going to fail?
Look, that's an interesting topic that I actually tapped into, which is what we call the understanding of the understanding of nature of the asset class that we have in the region. We have a big misunderstanding how the asset operates. Unlike any other region in the world, we don't have problem of capital scarcity, right? We have a problem of efficient redirection of capital toward where these industries are being done. When the oil and gas revolution came out, right, in the early 70s, and then started to commoditize later on, there was a huge immense of wealth that had been passed on toward a lot of individuals, and then a lot of family offices started to emerge, what we call first generation family offices, and from there on, there was theory of how that wealth should be managed. So they were deploying that capital on traditional asset class, which is real estate and hospitality, as it was evident in many other parts of the world, right? And then the second generation of these family offices, they were looking into more of deploying the private equity, because private equity was a little bit more riskier than the cash flow business, which is real estate and hospitality. And now we live in third generation of family offices, and you can feel the generational feud that happens between them. So the younger guys want to do more riskier assets. The older ones goes like, no, we want to keep this business as a cash flow business. So I think it's a matter of time before we have more risk capital in the ecosystem and how we look into risk capital. There was actually an interview with Jeff Bezos not too long ago, and he was asked about why America is amazing in fostering innovation, in fostering VC activities, and exporting all of these businesses to the world. And you go like, it's not about a banking system. I mean, Europe has an amazing banking system. China has an amazing banking system. It's not about how the capital markets operate either. I mean, a lot of other. I mean, London was the birthplace of capital markets, right?
Yeah.
And so what makes it? It's the culture of risk capital, of how that capital operates.
I read it.
And how that capital it manifests itself, and how that capital reaches to the entrepreneur beyond the traditional pathways. So I think it's a mindset for us to look into. It's an ecosystem play. It's not just a VC play, unfortunately. LPs has to understand how things operate. The nature of that asset class, how we make it more affordable, more value-oriented. Because, in my own opinion, VCs in the region has been an extraordinary good product for LPs, but it's been quite a horrible product for founders. Meaning,
we're part of that. I know where I read that article because you posted it right in our group. So now I know where I kind of. But it is kind of tough for those startups, and we're going to move into that area. Yeah. But it is tough for those founders that are looking for investment. And should they be looking for investment? All these questions that we're going through right now.
Look, every business has its own investor profile, risk profile. Should they even qualify for venture dollars or not? Not every business that started right now is a startup. A startup is, the universal definition of a startup is a tech company that they can do their own tech. And they're trying to either come up with a new way of doing things, disrupting entire industries, doing things better than what we have today, or completely creating what we call from a sci-fi perspective to bring it to the world. And that's how things it usually have been going for the past few years to come. Should they hunt venture dollars or not? It's a big topic. But one way or another, there's a lot of capital options and capital products of financial products in the market besides venture dollars that they can grow with. It's not necessarily the VC. It's not the ultimate route for everyone to go to. And one way or for another is that VCs as well to look into this from completely separate lens as well, I'd say.
I love the community that we're in. You've been from the very beginning with that community. And sometimes we get on there's those WhatsApp groups and we're quiet most of the time, but then something kind of strikes us or somebody saying something, and we want to try to help those. The startup ecosystem here is growing and it's developing. What things have we got? What more pain have we got to go through to get these startups really firing on all cylinders?
Look, we have to look at things from a realistic perspective, right? 10 years ago, bringing VC into the discussion was a completely off the books. I mean, what's a VC? It's an entirely new educational thing to go through and raise awareness. But today, no. Today, you find the ecosystem is more aware of how that operates. There's still hoops to go through, but the right ingredients to create an innovation ecosystem does exist here. In any ecosystem in the world, creating the right talent has to be a place. We have one of the best educational infrastructures in the region. Access to capital, we are working on closing those gaps. The QA as well as working on closing those gaps by creating the Fund of Funds program, by trying to bring sophisticated risk capital into the ecosystem. More family offices are participating into the ecosystem. We're seeing efforts of commercializations of research and bringing them to the market. There's still some hurdles in the corporate and private partnerships. Corporates today work with work with the proverb, or work with the saying. It goes like, a CEO never gets fired for hiring McKinsey, or it's what we used to say in cybersecurity, that CISOs never get fired for picking Cisco. It's the same concept. The same concept is that usually corporates trying to avoid risk. So they don't like to have startups mess around with their systems, or startups come around and try to deploy or pilot any of the projects. That risk mindset has to shift, and the ability of the corporates and the private sector in general to adopt, support, and encourage the startups is of a great deal. And in any ecosystem in the world, the success of that ecosystem depends greatly on the private sector, not on the public sector. The public sector can definitely support and orchestrate the capital inflows, the capital outflows, the regulations, support how these entrepreneurs work. But one way or another, the private sector has to take it forward. It's not the job of the public sector to manage companies or to be in the place of founders too.
We're here in 𝗟cie University, and you've got all of these mechanisms. So you've got the education, and you've got the private sector, and you've got the government side of things. And whose fault is it? Who needs to be doing more in those ecosystems? And I don't think anyone needs to do much more. Everybody's doing their part. We just need to speak to each other a little bit more. And I think that's with the corporate side is that risk adverse sometimes is sometimes I think that the system's not broke, so don't fix it. Let's not try to change too many things otherwise. But I think with the way that things are going right now, as you said, there's so many more families coming into the area, looking at different things. There's so many different. I know that the big corporates, we're doing the DHL for SMEs. Okay, is it for SMEs or is it for startups? Where that line is, I don't know. I know that there's loads of barriers, but I think it all fits all. And I think that there are private sectors coming together, but it takes time. It's trying to identify where things that are good out there that we can take advantage of, that people can learn from. And again, I keep on coming back to it, having these conversations, because I think this is where real things get managed, real things we can learn from each other. And I think we need to do more of that. But the ecosystem here, we've been around to different parts of the world, and there isn't very many differences. You've got to have a work ethic that is second to none, because competition out there is rife. And when I'm going in front of somebody, I better be good, because he's going to have a choice of 100 to 200 to 300, 400, 1,000 people queuing at his door. But you're now going into that VC. You've been a startup. What's going to make you different?
As a VC?
Yeah.
Founder empathy one.
Nice one. I'm going to follow you on this.
Founder empathy is definitely one. Look, when I was on the VC side, it's hard for you to see what founders usually go through. You're crunching numbers and see how the math works. But when you sit on the other side of the table, it's usually not how things works out. Startups are always messy on the back end of things. They're trying to juggle between products, between managing people, between getting to the market, to the consumer, closing the first deal, and all of that, adding the stress of the runway. Oh, we're running out of capital. It's a code red, we're running out of capital. And VCs will go like, sure, visit us in a couple of months. Let us know how that actually worked out. So no, I'll definitely do things differently. Probably I'll be the kind of VC that would actually take my stuff and go to the startup office and go like, okay, let's see why you lost your first customer. Let's see why you're not getting into market at time. Let's see why, and let's do it. Let's support. I understand how that goes. I've been in your shoes. I've been in your shoes where I have 30, 45 days left to runway. I'm like, okay, I'm going to send everyone an email shutting down the company. It happened. I was in that seat. It should be that way, and I understand now better why the best VCs in the world, or the tier 1 VCs in the world, they always tend to stand behind founders and trying to support, and they're trying to extend way beyond just venture dollars, because venture dollars, okay, yes, look, if you're in an investable company, venture dollars will come regardless, one way or another. It will come, but there's a big but there. What are you getting beyond that venture dollars? I mean, how can you overlook the fact that a lot of tier one investors today offer you what? Offer you Asia credits, offer you giant co-working spaces, offer you introductions to your first possible clients, integration with their portfolio company. They take you themselves to explore other financing options, or bring other co-investors with them. It's a lot of things that they can offer, that they can actually offer. This is why I said earlier, it's still a horrible product for founders here, because we haven't seen that from VCs yet. So they go like, oh, my VCs, he just gave me a check, and I didn't hear from him except 4 times a year when they call me. Oh, you have your quarterly reports. What are they? I can't see them. Why are you losing money? They don't care much, or they're not designed to care. Their mandate's different. So this is why private capital is very important, because when it's your money, when it's your neck on the front line, you start managing money differently.
Yeah, and I think that I've seen a few VCs that they just want 2 to 3x. They're not looking at this big stuff, but they're just looking at saying, just give me my returns. As simple as that. And a lot of things, and you can confirm this if you can. I see a lot of things, and I've heard this comment several times, is a VC or somebody that's going to borrow money is just looking for an excuse to say no.
Okay, so first, if you're looking into 2x or 3x in an early stage startup, you're going to fail anyway. So because it's usually in a portfolio of 25, 30 companies. Best case scenario, you will have 2 unicorns, and the rest is going to return 2 or 3x of the capital. Then the rest of the portfolio probably 1x, or even completely default, right? So maybe at a later stage you look at 2 or 3x, maybe pre-IPO, but early on that's a no-go. That's a no-go, absolutely. So what was the second part of the question?
The second part was whether they're just looking for an excuse to say no.
I was fortunate enough to work with people that they have the ability to say no when it's due. We said no to founders when we told them, hey, we don't have enough time or the bandwidth to look into a deal right now. Please shop for other capital if you can. We were very straightforward, and was fortunate to work with a team that was very transparent with founders down the way. But look, as we said earlier, there's 7 to 10% who return 1x. That means 90% of the VCs don't know what they're doing. So chances are you'll run up to those 90%. So your experience with them is not necessarily how they dictate how the market functions. Look, if we're looking to 5,000 VCs worldwide, and less than 5% of them actually do contribute to that founder's growth and do contribute positively or meaningfully to the company, we can actually sit down here and name them one by one. It's 5% of 5,000. So it's a narrow pool to look into. So I think that leads us to say it's more science than art. If you treat this as an art, you're not going anywhere.
Yeah, and having that if that's the case, then just make sure you do your market research. And make sure you look at those stats and look at the findings to make the better decision who you're going to approach. Don't waste your time. Look at the investors that could potentially want to invest in your type of market.
Well, absolutely. Look, picking up the right investor in your company, it's a must. Picking up the ones that they can bring more value to you.
Do you think that we can get quite desperate?
You can, and it happened to the best of the companies out there. It's not like they've taken money from people, probably they shouldn't. But founders have to manage. Sometimes you have to take a nasty hit to win the war, but sometimes it's a necessity, and I don't really blame founders. You try to take a deal that probably over dilutes you, or to take money from people they're not adding much to the cap table, or they're not so supporting with anything, just to get into the next 18 to 24 months of runway and then figure stuff out. It happens. it happens. It will be unrealistic as well to tell founders, oh, just stick to who can provide you better value. Sometimes you can't find any. It's the reality of the matter, and people has to take it that way.
And sometimes it's not just about the money, right? It's the services that that's VC's gonna be, or the angel, that service that they're gonna provide that's gonna actually bring a network that you could possibly reach out to. Just other things that could make all the difference within that business.
Absolutely. Look, the tier 1 and tier 2 VCs are not competing with to give you money. They are going to give you money regardless, right? Well, I'll presume you're investable, right? But they're competing on the front of what they're bringing to you, an additional of that venture dollars, and that we haven't seen yet in this part of the world.
No, but now you're saying that sounds pretty exciting. If you can get to that level of the scales where they're balancing out, when they all of a sudden go in your direction, where they are going to be fighting over your...
Exactly. Look, if it's a good investable company, highly likely is that it's going to be competitive to get into that cap table, and it has been the case, right? I think that's what the earlier data as well suggests, about $83 billion, about 41% of the venture dollars from year to date actually going to 10 deals. Can you imagine how competitive that was? Actually, to get into those cap tables. It's the same, by the way. If you're an investable founder, if you're an investable company that has a lot of potential, money is not going to be the issue. The issue would be who's going to bring more value on top of that venture dollar.
How quickly, we were saying how founders sometimes they're the operators. They've got to look at that next product. They're going to look at those staffing issues, the cash flows, so they're getting all tied up in these areas. It seems like it's pretty important that you get those messages right for the VC, making sure that you, when it comes to that time where you are going to somebody to raise that capital, you better make sure that your back end is right, because if it's not, they're going to find every single weakness. Due diligence, they'll find you wanting, right?
Look, dealing with companies at different stages of investment are different. Usually, if you're going to deal with early stage companies in a nascent ecosystems, highly likely 99% of the deal flow that I've seen, they're going to be messy on the back end. But it's not about being neat and clean. It's about being able to operate, being able to solve an actual problem, being able to tap into an actual need, build products that people actually want. That's where this is where your role as a VC comes, which is to support these companies. And when they meet their next investor, they're not going to repeat the same mistakes they repeated with you, rather than showing them the door. This is where your role comes. If you're investing in a later stage company, it's a bit of a different conversation, because you expect by then they're going to get their house in order, right? But early stage companies needs to be treated very differently. When I used to look into the deal flows and that, I was looking at them. Most of them did not have any kind of neat database or data room that they can show us, and most of them is fragmented all over the place. It was up for us to look into it, to see if we can make sense out of it. When we spent a lot of time just getting them piecing out that data together, by the way, it spends a lot of time on the due diligence phase, which probably we shouldn't, but it is part of our job as VCs as well. Maybe because as well I was wearing a hat of a developmental financial institution, where we should develop those founders as well. We can't just show every founder the doors because they have a messy data room, right? It doesn't work out. And it shouldn't work out.
I like that part. I like that part, because sometimes that fear is just, it can be crucifying for that startup.
Absolutely. Right? Look, you can easily see if a founder is determined to the ground in that startup and trying to solve actual problem, or you can see is that there's a founder who's trying to build something cool and he's trying to find a problem to pin that solution for it. It's a very two different categories of startups that exist, and you can easily see the genuinity behind it, right? We should be more founder friendly. We should be more founder supportive, not just as VCs, by the way, but as an entire ecosystem as well.
I like that too. You have changed a lot. You have. You have changed a lot.
Did I give you a term sheet?
I know that you've changed a lot, because I think if I was Bilal, the one that was in there, in the engine room, in all of those, you were quite direct. But I have seen a difference in you, and it's commendable. You've walked several different paths, and on both sides. What are those biggest tips that you would give a startup right now within this ecosystem?
Yes, I was a bit ruthless probably to the startups early on, but I think this is why important, and this is why probably the best VCs in the world, they come from operating experience.
I'm telling you honestly, I'm not just saying this to you, and I wouldn't try to patronize you in any way. I wanted to have a good debate with you. You've changed. There's a part of you that's changed, and I know that I've had that privilege of seeing you in different levels now, and I like it. So, okay, stop this. Tell me the best things that a startup could do, with all your experience, the best things a startup could do within this ecosystem here in Qatar.
Look, first, from startups, if we're talking about raising capital, chances are that you are in a better place to raise capital in Qatar than you are in the US right now. And people will be shocked. We're like, what do you mean about that?
There'll be eyebrows rising.
Like, what do you mean? I'm telling them that it's less competitive to raise capital here than you're going to raise in the States. In the States, that venture dollar is competing with another 10,000 startups, actually. And you know, I'll be looking into the data from what Y Combinator, or the 𝗟cie by Sequoia, which is a tier 1 accelerators for early stage startups, right? Their waiting list of startups, or their applicants for startups, in this cohort in the summer alone, reached 15,000 to 17,000 applicants, and they get about only a bunch of them. Sequoia only gets about 10 per cohort. Can you imagine? So if you're gonna get there, you need to be a category defining founder, right? With a category defining product, where you're gonna come from an ex Palantir, ex Microsoft, ex wherever, to provide that value added. But what I'm trying to tell people here in the ecosystem on the ground, one, you have better chances here. Second, try to build products that actually solve problems. Not products that are nice to have. A nice to have product can be wiped out by a feature, by a competition. Usually you wanna try to understand your market better. You wanna try to understand what the investment landscape looks like. You wanna learn as much as you can. You wanna fail as early as you can, because later on those failures can get quite expensive. Be open to coaching. Be open to for the ecosystem to probably show you how things are done, which is a trait that I've seen a lot of founders which are uncoachable. They can't. They like it's one of probably the most red flags you see in founders, that they're too self-centric. They cannot be. They want to do things their own way, regardless of how the ecosystem works.
We sometimes can't listen, right? We don't listen. We find it difficult too, because we don't think they understand the path that we're taking. Sometimes I've been there. I've been there. I've been defensive. So everything that you get shot at you, you're trying to fight back, instead of, okay, take it. If you've seen this, then I've got something not right yet.
It's a joint collaboration in the ecosystem, because I'll tell you specifically why. If you're going to bring someone that has no operating background, never managed capital in their lives, never deployed capital in their life, and trying to give me an advice, what are you advising me on?
Yeah. Yeah, but this is where I've always.
Did you see my point?
I think there's people out there that's got skill sets. I would never, ever, ever profess that I could do that stuff. But I know that I've been with big companies, big multi-million-pound companies, that I know that I'm capable of giving advice in certain areas. So I think that there are things that you've got to. I think with me, and I'm just interacting with you, I think you have to have people in special fields to give you the right advice where you're having problems with.
Oh, absolutely. Look, specialists in certain fields, they're needed. Like if you're going to bring in AI, an AI researcher has been working on fierce models for quite some time, and they're trying to fine-tune your approach toward architecture or whatever. He's definitely the person to listen to. A VC is not going to be much of help for you at that point, right?
Yeah.
But I'm trying to tell you is that trying to accept the advice from who can give it, from whomever can offer it, or who's eligible to offer it. That's what I call it. And the ecosystem has to provide that mechanism as well. If we keep bringing people that have no background in whatever advice that they're trying to offer to people, that's another problem that I've seen as well.
Yeah, I agree. I do agree with you.
This is why I said it's a joint responsibility for the ecosystem, because the ecosystem has to understand as well the startup as an asset. How do we look at these startups? What can we offer them to support them? What can we do for them to make them succeed? How can we make them exportable outside? Look, Qatar is in a special situation, right? So the innovation ecosystem here is quite nascent, but it has the ability to grow faster than others, right? Because we are learning from very mature ecosystem, and we have the ability to develop that. Look, we have one of the best asset managers in the world are sitting within 12 kilometers square. We have one of the best healthcare providers, airlines, airport, industry incumbents that they can support your growth. If you were to hunt if you were to hunt these incumbents anywhere else in Western Europe or in the States, you're going to burn through the entire seed round to actually get in front of these guys. That being said, it's a joint responsibility between public and private sector to get things up and running and to get things in.
Yeah, but I see I do see the private sector doing things, and I do see the government side of things. Those ICANN, HMC, Ministry of Public Health. I look at those things that they're doing just in the health sector. But the sports, let's look at the sports. We were just starting in a couple of months' time. We've got the under-17s World Cup. In football, we've got the basketball 2027. We've got the Asian Games in 2030. We're hoping that they're going to be going for the Olympics in 2036. It's like the one thing that I would say to anybody that's planning on coming here or to start up here is that you better. There's so many hungry people. Standing still is just not an option. You've got to be, you stand still, you're moving backwards. You've got to be pushing. And you've got to be operating such a higher level than you ever anticipated, because there's somebody that's going to be chasing after you.
Look, we need to understand there's an economic term that says comparative advantages. Comparative advantages entails that each country has some form of advantages in either creating value to its citizens or its residents, right? Qatar may not be the market for startups to expand to or to come to, right? But it's an excellent platform for startups to emerge from. You have everything that you need to do so. And first row regulators are starting to see that maybe Qatar can be the Singapore of the Asian market, where we foster innovation, we support these founders, and then they can move on to Saudi, to UAE, to Kuwait, to continue offering to a larger consumer base or to larger private sector. But there's a lot can be done early on in this market here, and I think that's what the Sovereign Wealth Fund is trying to bridge as well through their Fund of Funds program. There's another question I keep hearing in the past 6 to 7 months. Why QIA is not participating directly in these deals in the country? Why QIA is not doing that? Why QIA is not launching their own VC fund? But people do not understand how these sovereign wealth funds operate. They have no understanding of being in the seat of wealth managers of a country. They have to understand that QIA as an institution, they do manage the back pocket of the country, so they are mandated to sustain that wealth and progress it. If we look into, and by the way, QIA is no exception. If we look into the largest sovereign wealth fund in the world, which is the Norwegian pension fund, right? Pension fund is not necessarily like an oil and gas fund, right? They're not allowed to do any private equity, let alone VC. It's $1.8 trillion of assets under management. 70% of them goes to public market, 27% of them goes to fixed income, and the rest of it goes to real estate. They were trying to get the parliament to even approve 1% of their capital directed to a private equity, and they said no, it's a riskier asset to do. So what I'm trying to tell you here, QIA is trying to orchestrate some form of risk capital into the country where others in the world may not be able to do so. And they're doing it in their capacity of supporting the entire macroeconomic conditions rather than being standalone asset managers. They're trying to bring sophisticated, knowledgeable funds that they can do so rather than them doing it on their own. And they can afford to do so. And we have seen some of them already have Sature in the region.
I think what they're doing, because they're doing it for their people, they're doing it for their country. Everything that they look at is for the biggest thing, I think, that once they've learned it, and it's like the countries that we've been to, Armenia for one, is their diaspora is all around the world. So they've only got 3 million people in Armenia, but they've got 7 million people outside, right? And once we get the corporate diaspora right here, then there's going to be companies going out left, right, and center around the world to deploy their business, expanding.
Armenia has been quite an interesting case to see that their diaspora outside of Armenia, they're heavily connected to the innovation ecosystem. It's insane that they're reversing a lot of risk capital to the ecosystem. They're reversing a lot of innovation towards it, and it's serving them pretty well. We would love to see how the local ecosystem as well can be highly connected outside through similar channels, or maybe because we don't have diaspora of locals outside, right? But there are many other channels that we can do. We can create synthetic channels for a lot of these founders to be connected outside in these ecosystems and do so.
And that's what we were doing
in Armenia. Yeah, absolutely.
It was a phenomenal thing. No, I think the future's bright. You've just, unfortunately, your work ethic has got to be absolutely fantastic. And sometimes, listen, what you were saying before about those tips for different companies, it's just do the basics. If you do those basics right, I get fascinated when I talk to people and I ask them about what should they be doing. It's the same old things. It doesn't change. There isn't anything. Make sure that your product, there is a need for your product. Provide a solution to a problem, a real problem. And those are the things. Find the great team. Have people on your team that is unbelievable. Let that investor know that you've got experts and you're all working towards that problem-solving piece. So it doesn't change. All you've got to do is you've got to have that desire, you've got to have that work ethic, and you've got to give it the best shot that you've got. This is no dress rehearsal. This is a real deal. You get one shot at this and you've got to give it the best one.
No, I absolutely agree. Usually category-defined founders or great founders, they tend to have all of this component gravitates around them, and they know how.
But I think that when you see those, I listen to all those people, just like you. I listen to all these people, and the biggest thing that they say that's got to be on your side more than anything else is your timing. Timing. So so what they're saying basically is you've got to be a little bit lucky, because there's a hit and miss, like Betamax in VHS. Timing. YouTube, there was one before YouTube. I can't remember what it was. Airbnb. Some of these companies wouldn't have succeeded if it was in a different time zone.
Oh yeah, absolutely. So yeah, market timing is important. I mean, look, there are several zones where founders play on. Either you are transforming how certain technology operates entirely, which is a lot of VCs around the world talked about, like the 0 to 1 by 𝗕𝗿𝗄 or the product market fit and founder market fit, and the blueprint by Sequoia. It's like transforming entirely. You present a new way of how to deal with a problem, or how to solve that problem. Or it was completely sci-fi to see. Like a few years back, if we look into, how about we have an agent that takes care of all of your workflow? You go like, that's far from happening. Fast forward 3-4 years later, you go like, it's not that far from happening anymore. You can see founders try to offer a better way of how things operate. They see there's inefficiencies in products or services that are being offered, and they're trying to make that better. And you may find that a little bit of a crowded space as well to work on. So they have to operate, and they know exactly what kind of problem they're trying to solve, and what does the market looks like for that problem, and they have to bring and attract the right talent for it. And it's not easy, by the way. Look, it's never an easy game. We can tell founders all day, go back to the basics, do this and do that, but it's not as easy.
It's not easy. It's not. But sometimes you've got to trust on. And I know this is going to go real off topic really quickly, but search engine optimization when I was a little bit younger. And search engine optimization was coming in because I've seen it all come through, right? And you used to do the Dreamweaver special. So you'd do a great design for the website. You'd go into Apple, you'd press a button, and we called it the Dreamweaver. So go into Dreamweaver, put the design for the website there, press a button, hey presto. Fantastic design. You were the head and shoulders above everybody else, but it was no good for search engine optimization. So you had you thought that you were so far in front, but you had a real drawback. And so everybody used to criticize us because we didn't take that into account. And I remember learning in those things. And for search engine optimization in those days, you had to have blind belief, right? You had to do those things, the good things, the basic things, the things that everybody taught you. Nobody knew how those algorithms were going to work ultimately. But if you stuck to the fundamentals, in 6 months' time, if you had blind belief, you were going to see results. And that's where I think sometimes with the founders are, where I say, look, just stick to the basic, but just do them real well. Get them to let people see your work ethic, because people are going to buy people ultimately. And those are my things. So have that blind belief that whatever you're working towards, sometimes you're not going to see any results until 6 months later, even a year later. So just keep going, have that blind belief. I know that we're going to have you back on this podcast because I found it a fascinating chat. And I think it's really beneficial for people out there so that we can empathize with them. We do know what they're going through and we can give them some kind of solution. So please ask those questions, send questions into us where we can answer them here on the podcast. The one thing that I always ask my guests, especially is everybody, what message would you give your 15-year-old self right now? 15-year-old self?
Yeah. Look, that reminds me of something Sam Altman said about 3 weeks ago. They go like the children that are going to be born today, they will never know life without artificial intelligence. That drives me to say this is, as a 15 years old, I will digest everything I can know about artificial intelligence and be a very good student to understand how technology really operates, because that's going to dictate how we're going to look into the world and how we're going to consume, dispose products, how we operate in markets. It's going to change the entire game. It reminds me of the Industrial Revolution that happened in the 17th and the 18th century. A lot of when we introduced the machines, a lot of people go like, the machine's going to take out all of our jobs, and the machines we're not going to leave anything but for us. But what really happened is that we had to upskill an entire communities to operate, and from there on, our entire GDP per capita exploded. So we had better products, we had better quality of life. I think this is where we're hitting the same barrier again, right? So we hit that barrier again, I think, with the .com bubble, where we transformed how we look into products and services as well. I think this is where we foundationally as well, everything is going to change. And as a 15 years old, I will definitely try my best to understand where we're heading as a society, where we're heading as an economy, where we're heading as a social context and a social fabric as well. Try to fit in as much as I can, because look, whomever is going to stay outside of this AI shift is going to find a really hard time clawing back to where it is.
I think it's going to be one of those that everybody eventually embraces it. I know that I've embraced it. I know that it's a big part of my life, and I enjoy. He's my friend, and he's my partner, right? And when you've got a partner and friend like that, then there isn't anything. I'm going to put this because I think I should make this clear. I think this is going to bring communication back to one-on-one even more, because it's great to have those things to help you, but it's going to give you more times to have those relationships on a human level. And I think that's going to help so much and going forward. But embrace AI as much as possible.
Yes, embrace AI as much as possible, but as well, it creates a parallel opportunity for the real world products and services too. So as much as we invest in AI and once we adopt an AI, one-to-one communications or human-to-human communications will become much more important, and will be a lot of space to play there as well. It is going to transform how we look into our lives and how we deal with our lives, but maintaining the human component, I think it is an equal importance.
Bilel, it's great having you as a friend. I really admire the steps you've taken. I've really admired what you've done, and the way that you're changing, and the way that you're helping so many others. So keep it up, the great work, and
thank you.
And let's do this podcast on a more regular basis.
Well, I'm happy to. Thank you very much for having me.
Thank you for being with us today. Thank you. Everybody, I hope you enjoyed that. It was looking at things from a different perspective, but not just looking at what the VC wants, but looking from a person's journey from how they started is that startup. They found the hard ways, and now they're going to put all that stuff that they've learned over that time with Bilel. You're going to find out how they're going to take that into the VC world, and they're going to make it easier for those people that really want to do those tough things, those things that are going to make a difference. I hope you enjoyed this podcast. Thank you for listening. On that note, I'd like to thank 𝗟𝗟cie University for letting us use the facilities. I really have been struck by the way that they have a family, a community here in their new university near 𝗕𝗹𝗲𝘃𝗿. It's a phenomenal facility, and I can only thank them so much for letting us use it. Thank you so much, 𝗟𝗟cie. And thank you again, Bilel. Thanks for a wonderful podcast.
More than happy to.
Thank you.
More than happy to. A pleasure to be here.